$6.7 billion for a clinical stage company. Merck is paying $53 a share for pure potential.
When that potential is a novel leukemia drug, you write the check. They desperately need that hematology pipeline.
You only like this because private equity volume is down 32% and your banker buddies are bored.
Restless dealmakers are dangerous, Maya. Just look at Krispy Kreme panic-selling stores to deleverage. But seriously, did Merck just buy a blockbuster or a massive money pit? The rundown. So global M&A volume is down 12% year over year. Private equity deals are down 32%. 32. That's a third of the market just vanishing into thin air.
Which completely explains Advent buying a majority stake in Salt and Stone.
Exactly. Dealmakers are so bored, they're literally acquiring deodorant companies. I can just picture the investment committee, we can't find a decent software buyout. So let's pivot to premium eucalyptus body wash.
Hey, high-margin consumer goods are a safe harbor when debt is expensive, and it's better than Bow River Capital buying Spur Capital Partners. A private equity firm buying a venture capital firm is just fees layered on top of fees. But if you want to talk about weird allocations of capital, Southfield Capital just crossed the pond and dropped $100 million to buy Metric Search, a UK executive search firm.
It makes total sense. You're buying a cash-flowing services business with a transatlantic footprint. Headhunters are basically toll booths for corporate growth.
Oh, come on. $100 million for a recruitment agency right now, when the entire white-collar job market is contracting. I read the press release and it's just wall-to-wall synergy buzzwords. There is no moat there.
The moat is the Rolodex, Maya. You can't scrape top-tier executive relationships off LinkedIn.
I guarantee an AI agent is going to scrape most of it by next year. But fine, let's look at real panic. Krispy Kreme is quietly scrambling to fix its balance sheet. They're refranchising a huge chunk of their Western US footprint to WKS Restaurant Group.
The great sugar deleveraging, they are desperate to shed debt. Which actually brings me to some good news on the regulatory front. Ireland is starting public consultations to raise their M&A notification thresholds.
Finally, European watchdogs realizing they don't need to investigate every time a middle market manufacturer changes hands. Like Chimney Rock buying United Electronics Company, they just want to focus their firepower strictly on high-value, market-altering mergers.
Right, less paperwork for the middle market. It might actually unblock some cross-border deals.
We'll see if other regulators follow suit. But speaking of market-altering mergers, we need to talk about what's happening in oncology.
Oh yeah, $6.7 billion of all-cash aggression.
Merck is not messing around. They're paying $53 a share for Terns Pharmaceuticals. And the structure of this deal tells a massive story about their hematology pipeline. Tani Manu? The big one.
$6.7 billion in all cash. For a clinical stage company?
I had to refresh the terminal 3 times this morning. $53 a share for Terns Pharmaceuticals. Merck is seriously not messing around with their hematology pipeline.
They cannot afford to. This is classic big pharma strategy. They need a successor to their aging blockbusters, and Terns 701 is the holy grail for chronic myeloid leukemia. I honestly think it is a brilliant land grab.
Brilliant? Nate, holy grail is a massive stretch. It is clinical stage. They just dropped nearly $7 billion on potential. I read the footnotes on this pipeline. If Terns 701 hits a wall in phase 3, Merck just set a mountain of cash on fire.
But if it works, they own the CML market for the next decade. You have to pay up for that kind of dominance.
Sure, but $53 a share? The premium is absurd. The phrase highly anticipated in their press release is doing a lot of heavy lifting to justify that valuation. It feels like they bid against themselves. Who else was writing a $6 billion check for a CML drug right now?
Everyone wants oncology assets, Maya. And look at the macro environment. Global M&A volume is down 12% year over year. Private equity deals have cratered by 32%. Money is sitting on the sidelines getting restless. Merck has the cash, so they are bullying their way into the asset while financial sponsors are paralyzed.
I will give you that. The drop in PE activity is stark. A 32% contraction in the first 2 months of the year is brutal.
My old managing directors must be staring at the wall right now. Bored deal makers are dangerous.
Dangerous, and dealing with very restless LPs. You can only update a pitch deck so many times before someone asks where the returns are.
Exactly. When the sponsors pull back, strategics like Merck get to play kingmaker. They do not need debt financing to clear a $6.7 billion hurdle. They just wire the money.
I still think they overpaid, but you are right about the board bankers. Maybe they are all just stress eating, which actually perfectly explains our next note. Krispy Kreme.
Oh man, the great donut deleveraging.
You laugh, but they are quietly scrambling to fix their balance sheet. They just offloaded another huge chunk of their Western US footprint to WKS Restaurant Group.
A turnaround refranchising plan hidden under a pile of glaze. I love it.
It is actually a pretty clever way to shed debt while no one is looking. But speaking of shedding things, Advent just took a majority stake in a premium deodorant brand, and I desperately need you to explain why a massive PE giant cares about Los Angeles body care. Voices.
I read that same analyst note this morning, and the phrase sluggish start is doing a lot of heavy lifting. Global M&A volume is down 12% year over year.
And private equity deals are down a stark 32%, which explains why my inbox is full of rumors about restless limited partners.
Oh, the deal makers are bored out of their minds right now. You can practically hear the thumbs twiddling across Wall Street. They're desperate to deploy capital, so they're just chasing anything that moves.
I completely disagree with the board narrative, Nate. Look at the actual term sheets. They aren't bored, they're just avoiding antitrust scrutiny by playing in the weird corners of the middle market. Advent just bought a majority stake in Salt & Stone, a premium body care brand.
Hey, everyone needs good deodorant, especially stressed out bankers.
Sure, but then Southfield Capital just crossed the pond to drop $100 million on Metric Search, a UK headhunting firm. Bow River is acquiring Spur Capital. Private equity firms are literally just buying other capital allocators right now.
That's just the middle market keeping the lights on. But you have to admit the regulatory environment is finally throwing us a bone. Observers are saying Ireland pushing to raise mandatory M&A notification thresholds is a pragmatic shift by European watchdogs.
You think that's them being pragmatic? Please. They're just overwhelmed. They want to save their firepower for the market-altering stuff. They don't want to review a filing every time Krispy Kreme quietly sells another franchise out west to deleverage.
Krispy Kreme offloading their Western U.S. footprint to WKS Restaurant Group is a highly strategic turnaround play. Don't mock the glazed restructuring.
I'm not mocking it. I'm just saying, regulators only want to hunt whales right now.
Speaking of whales, we need to talk about the biggest fish of the week. Merck just dropped $6.7 billion in all cash, and they definitely aren't buying donuts. Spill the tea. I am telling you, bored private equity guys are the most dangerous people on Wall Street.
Oh, they are absolutely losing their minds right now. Global PE deals are down 32% in the first 2 months of the year. LPs are getting restless.
32%. So what do you do when the mega buyouts dry up? You buy deodorant.
Wait, is this the Advent deal?
Yes, Advent just signed to buy a majority stake in Salt & Stone, an LA body care brand.
It is literally $50 armpit paste.
Hey, do not knock the paste. People want luxury pits. And when global M&A volume falls 12% year over year, you find cash flow wherever it smells best.
You think it is a brilliant pivot? I think it is just too much dry powder burning a hole in their Patagonia vests. Just look at Southfield Capital crossing the pond to buy a UK executive search firm for $100 million. They are doing anything to look busy.
Oh, come on. It is strategic. Same with Krispy Kreme.
Okay, Krispy Kreme is a completely different story. They are quietly scrambling to deleverage.
Exactly. They just offloaded a massive chunk of their Western U.S. footprint to WKS Restaurant Group.
Refranchising is such a polite corporate word for we took on too much debt, and now we have to sell the furniture. I read the footnotes on that one. It is pure panic.
See, my banker brain respects the hustle, shrink to grow, get the liabilities off the books.
Your banker brain just likes the advisory fees on those spin-offs.
Guilty, but hey, it is not all tiny deodorant deals and donut shop fire sales. Some people are actually still writing giant checks.
Giant all-cash checks. Merck is dropping $6.7 billion, and I have some serious questions about the Terns Pharmaceuticals premium. Tomorrow's radar.
Private equity volume is down 32%. Dealmakers are bored, LPs are restless. Advent just bought a premium deodorant brand, Maya, Salt, and Stone.
Body care is highly defensive. People still sweat in a recession.
Oh, come on, they have billions in dry powder and they are buying armpit rollers?
I completely disagree. They are just playing it smart. Watch Ireland tomorrow. They are opening public consultation to raise their M&A notification thresholds.
Wait, really? A European watchdog actually asking to see fewer deals?
Exactly. They want to stop wasting time on tiny transactions, which is why Home Depot is quietly hoovering up bolt-ons like Mingledorf right under the antitrust radar.
Meanwhile, Krispy Kreme is quietly dumping its Western footprint to WKS Restaurant Group just to deleverage. Glazed and confused.
Whatever fixes the balance sheet.
Speaking of massive sugar highs that might crash, we need to talk about Merck dropping $6.7 billion in cash for Terns Pharmaceuticals.
I pulled the trial data on that one, and the premium they paid is wild.